Morning, everybody. The February 5th, 2019 School Land Board meeting will now come to order. First item on the agenda is approval of minutes from our last meeting on December 18th. After the board has had a chance to review and assuming no questions, comments, I could entertain a motion to confirm. I don't know if all board members were present. All board members were present at that time.
Motion to confirm.
Second.
Motion is made and seconded, so the motion carries unanimously to approve the minutes. Next item on the agenda is the approval of the consent agenda. I've been notified that item number 2, E1, has been pulled from the docket. So I'll ask the board members to strike that from their copy of the consent agenda. And after the board has had a chance to review the consent agenda as revised, and assuming no questions or comments, I could entertain a motion to approve the consent agenda as posted.
Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve the consent agenda as posted. Items number 3 through 8 will be held in executive session. We'll do so under Chapter 551, Subchapter D, Section 551, Tech 071, the Government Code, for discussion, consideration regarding pending or contemplated litigation and/or settlement offers, or to seek or receive attorney advice or counsel related to items 3 through 8 on the docket. We'll also enter executive session subject to subsection 551 Tech 072 for discussion consideration concerning the purchase, sale, exchange, lease, or value of real property related to items 3 through 8 on the docket. Following executive session, we will reconvene in open session to complete the docket. The open session of the February 5th, 2019 School Land Board meeting will now resume with item number 3.
Good morning, Amber Long, Asset Management. Staff recommends approval of the disposition of tax foreclosure land per the terms discussed in closed session as being in the best interest of the state. Any questions?
Any questions at this
I
time?
have no questions.
No questions. Move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 3. Next item, thank you. Next item on the agenda is number 4.
Sean Seal with the Asset Management Division. Staff recommends the board waive their first option to purchase of the Marion County cabin as discussed in executive session. Any questions?
No questions here.
Could entertain a motion at this time.
Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 4. We will waive our right. Next item on the agenda is number 5.
Sean Seal with the Asset Management Division. Staff recommends the board waive their first option to purchase of the DPS Paris office as discussed in executive session. Any questions?
Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 5. We'll also waive our option on this one. Next item on the agenda is number 6.
Sean Seal with the Asset Management Division. Staff recommends the board waive their first option to purchase of 0.32 acres of the San Angelo State Supported Living Center as discussed in executive session. Any questions?
Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 6. Thank you. Next item on the agenda is number 7.
David Wells with Asset Management. Staff recommends approval of docket item number 7 per the terms discussed in executive session.
Any questions for the staff at this time on the budget?
Move to approve.
Second.
Motion is made, seconded, carries unanimously to approve item number 7. Next item on the agenda is number 8.
David Wells with Asset Management. Staff recommends approval of docket item number 8 per the terms discussed in executive session.
Move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 8. Final item on the agenda is number 9, quarterly investment report.
Thank you, Mr. Chairman, members. For the record, Rusty Martin, Chief Investment Officer. I'm pleased to present you with quarterly investment report of the Texglo Permanent School Fund investment portfolio for the period July 1st through September 30, 2018. Performance measurement calculations and the statistical data that are presented in the report were prepared by State Street Bank and its private edge group. They are the custodial accounting and performance measurement agents for the portfolio. Before I begin, I'll remind you that this is a non-voting item, informational only. Briefly, a summary of economic conditions during the period. Third quarter U.S. GDP increased at an annual rate of 3.5% after increasing 4.2% in the second quarter. U.S. unemployment rate ended the quarter at 3.7%. The Fed, through its Federal Open Market Committee, raised its target Fed funds rate range from 1.75 to 2% to 2% to 2.25% at its September meeting. They also continued to tweak the balance sheet back in what they call a normalization program, and that concerns the reinvestment of principal payments from its holdings in agency mortgage-backed securities and the rolling over at auction of maturing Treasury securities. They also agreed that the timing and size of future adjustments in the Fed funds target range would depend upon their assessment of realized and expected economic conditions relative to the committee's maximum employment objective and their symmetric 2% inflation objective. In addition, they also agreed to remove the sentence indicating that the stance of monetary policy remains accommodative from their post-meeting statement. With regard to the U.S. commercial real estate market, as measured by the Unlevered NCREIF Property Index, which we call NPI, it returned 1.67% for the quarter. Its trailing one-year return was 7.16%. Occupancy rose during the quarter to 94.17%. That's the highest since the fourth quarter of 2000. And cap rates declined to the lowest level in the entire history of the index. The third quarter, and that index has been around since the first quarter of 1978, so significantly low cap rates. Third quarter, gross total returns for each of the individual sectors of the NPI were hotel, 3.22%, retail, 0.56%, apartment, 1.55%, industrial continued to be strong, 3.36%, and office, 1.69%. And again, industrial was the best performing sector during the quarter, and that's due to continued strong performance of industrial warehouse space. In the energy markets, WTI spot oil prices averaged about $70 a barrel during the third quarter. Hard to believe we're down around $55 a barrel now. It ended the quarter at $73.16 a barrel, and that was a 1.3% decrease from the second quarter ending price of $74.13 a barrel. Increased OPEC and Russian production were offset by supply concerns from Iran due to looming U.S. sanctions and Venezuela due to its ongoing economic crisis. In addition, the escalating trade war with China could also temper global demand growth. However, there are several medium-term risks that could push prices higher in 2019, including U.S. sanctions on Iran, escalating civil unrest in Venezuela, continued pipeline constraints in the Permian Basin, and a lack of spare capacity in Saudi Arabia. With regard to natural gas, spot prices continued to hover around $3 a million BTU during the third quarter. They averaged $2.93 per million BTU, and they ended the period at $3.01. That was about a 1.7% increase above the second quarter ending price of $2.96 a million BTU. Most analysts continue to think that rising industrial demand, LNG exports, increased exports to Mexico, and continued coal to gas switching will foster long-term supply and demand support. However, medium-term price upside potential is limited given continued strong domestic supply growth, which is expected to continue to exceed domestic demand. In accordance with the investment strategy adopted by the IAC in January of last year, the primary focus of the portfolio during the quarter continued to be on potential investments and co-investments in infrastructure, niche opportunities in real estate, and co-investment opportunities in energy. Turning to the actual performance of the fund, if you'll turn to page 2 of the report, we'll run through some numbers. Total NAV at September 30 was about $7.539 billion. The portfolio itself was about $3.65 billion of that, and cash equivalent investments awaiting capital calls was about $3.88 billion, roughly 50% portfolio, 50% cash, most of it waiting to be called. The performance, in a word, the performance was outstanding. There's no other way to describe the performance, not just during the quarter, but the trailing periods too. The quarter, the performance was 6.79% versus 1.36% on the benchmark. That's an outperformance of 543 basis points, almost a 5x. The infrastructure sector of the portfolio was up 2.46% for the quarter. Real estate was up 3.06%, and energy was up an astounding 11.3% for the quarter. The one-year returns off the charts. The portfolio returned 23.52% versus 6.69% on the benchmark. That's an outperformance of 1,683 basis points, or about a 3.5x. And again, these are gross returns without cash. The one-year sector returns, energy was up 34.6%, infrastructure 20.77%, real estate 11.14%.
Those are outstanding. That's,
Excuse me?
those are outstanding. I'm just trying to think here what the investments are to be that far outside of the norm.
Well, it's not just, and I'll go through the rest of it too, it's not just a one-year performance that's just so good. The three-year performance is 17.13%, so that means the average performance per year for the last 3 years has been over 17% versus about 6.8% on the benchmark.
What's the weighted percentage of energy over real estate?
I'll get to that in just a few minutes. The 5-year return is 15.86% versus 7.85% on the benchmark. Again, it's a 2x on the 5-year return. At the end of the period, about 36%, which was about $2.44 billion of the total existing capital commitments remained unfunded. 25% of real estate was still unfunded, 46% of infrastructure, and 36% of energy. If you turn to page 3 of the report, and also part of this will be on page 15. As far as new investments during the quarter, the board approved one new fund investment in a non-core real estate fund totaling $75 million, and also approved the expansion of an existing midstream energy infrastructure co-investment made alongside EnCap Flat Rock Midstream Fund 3 through Capital Co-Investments 8, LLC, and that was an increase of $180 million from $72.5 million to $252.25 million. In the fourth quarter, the board approved, this is subsequent events on page 15. In the fourth quarter, the board approved one new fund investment in non-core real estate, totaled $250 million, and one new energy fund investment totaling $200 million, along with the expansion of an existing core real estate capital commitment from $75 million to $200 million. Turning to page 7 and 8, we'll look at the allocations by asset type, and this will get to your question, Gil. So on a purely invested basis, in other words, on an NAV-based analysis, the portfolio was slightly underallocated to real estate at the end of September at 31% versus a target of 33%. Infrastructure was at 25% versus a target of 32%, and energy was at 44% versus a target of 35%. The low infrastructure allocation, or relatively low infrastructure allocation, is primarily due to several monetizations in that sector. The portfolio that resulted in significant amounts of capital being returned. However, those allocations will continue to change over time and become more in line with our policy allocation targets as more of the unfunded capital commitments to infrastructure and energy become funded. For example, if you look on page 8, this is looking at the allocations based not only on NAV but also plus unfunded commitments, and you can see the difference there. Real estate allocation on that basis was 27% versus a 33% target. Infrastructure was at 30% versus a 32% target, and energy was at 43%. As far as geographic diversification, pages 11 to 12, portfolio is close to the targeted allocation for each geographic region. Currently, the allocation to the U.S. is about 95% of the portfolio compared to a target of 90%, and the international allocation is around 5% compared to a target of 10%. And finally, looking at the investment manager exposure, this is on page 13 to 14 of the report. This is based on net asset value. On a purely invested basis, the portfolio is well diversified across a platform of 26 different investment managers. The policy statement limits the exposure to any one manager to no more than 20% of the total portfolio. At September 30th, the manager exposures are all well within that range. The top 5 highest exposures are to USAA Real Estate at 10.32%. That's followed by NCAP Energy at a little over 9%, NCAP Flat Rock Midstream at 8.2%, Macquarie Infrastructure Partners 4.9%, and Lime Rock Resources at 4.8%. The co-investment vehicles are grouped by manager and presented separately. The highest grouped co-investment exposures at the end of the quarter were First Reserve at roughly 7.7%, followed by Intervest 6.2%, and NCAP Flat Rock Midstream at 5.2%. That concludes my presentation. As I mentioned, this is a non-voting item, but I'm happy to answer any questions you may have.
Yeah, Rusty, let me, if I go back to page 2, okay, let me just try to
Sure.
clearly understand. So when you go to the portfolio, you go gross of fees without cash and then with cash. So if I take those two numbers, you're saying about $3 billion is in the form of cash?
Roughly 3.5 cash and 3.5.
And how does that cash sit?
investments.
Where does it sit?
So we are required to keep any money that's not invested in real assets at the state treasury. So it's invested in what they call the treasury pool, which is it's sort of like it's not exactly like a money market fund, although it works like a money market fund in that it's a cash in, cash out plus interest. But it's sort of like a short-term bond fund. The average duration in there is typically somewhere around 1.25 years, between 1.25 and 1.5 years. And it's currently yielding about 2.5%.
And is it statutory you have to keep a certain percentage
Yes.
cash?
Yes.
What's that?
Well, no, not a percent, no. But any money that is not invested in real assets, we're required to keep at the treasury.
But could you invest that $3 billion, I mean, could you invest that into assets and have a zero cash balance?
Well, about $2.5 billion of that is already committed. It just hasn't been called
Well, it
yet.
hadn't been called.
Hasn't been called yet. So, yeah, you've already taken the action to commit the capital. But, you know, the investment period on a lot of these investments is 3
Right.
years, 3 to 5 years. So it can take a long time for that money to be called.
Okay.
So that's what that is. That's why when we talk about performance, you know, we look at the performance gross without cash, because the cash, we can't do anything with it except put it in the treasury. There's not, so if you look at the cash numbers, it's not really reflective of the investment performance.
Okay. Outstanding job.
Thank you very much.
And Rusty, I don't know if you already stated, but what percentage of the cash is committed capital of that $3.5 billion? If you had to project?
So at this point, there was about call it roughly $2.5 billion that was committed.
And just to be clear, there's under statute, with the remaining cash that's not committed, it cannot be pledged to, it cannot reside anywhere else other than, say, the treasury markets that you stated.
Right. We have no other investment authority other than the real assets investments that we make and that you approve. The only other thing we can do with the money is keep it at the treasury, or the board can release it either to the available school fund or the SBOE for investment in the PSF, which, you know, that's a matter you undertake every 2 years.
have a look ahead for investments you're looking at? And so if we've got $3 billion in cash, $2.5 billion's committed, we have $500 million available. Do you have some things looking forward to invest in?
Sure. And of course, there are other, there are monies that you have already voted to release during the year that will come out of that uncommitted balance too. So that whole amount is not available to commit. So we just had our strategic meeting for the Investment Advisory Committee a couple of weeks ago to develop our strategic plan for this year. And so whatever is of that amount that was not committed and available was rolled into the projections for this year. So our projections are, at this point, our projections are that we will be able to commit about $1.5 billion this year if we can find the opportunities to, to make good investments and commit that capital. So that will be our goal during the year. Approximately 50% of that amount, $750 million, would be targeted towards infrastructure investments because that's the lowest category right now, again, because of what I told you. The next category would be real estate, which I believe we targeted $450 million. And then the last category, energy, we targeted $300 million because we're over-allocated at this point. But of course, if we see, we're energy investors. We know how to do that. If we see opportunities that exist that would ultimately cause us to be over that allocation, that doesn't mean that we wouldn't pursue them and take a look at them and present them to the board one way or another. But right now, it's going to be infrastructure, real estate, and energy in that order.
That's a good explanation. So a lot of the $1.5 billion that you're looking at is going to be able to be in our coffers to be able to invest based on projected liquidity events?
Right, based on our expectations for revenues generated primarily from oil and gas royalties and the portfolio itself.
Oh, so part of that is revenue is coming in from royalties, and what does that equate to? What do you have that projected to in 2019?
It's been quite high the past 2 years. I believe all in last year we were about $1.6 billion, and the year before that we were about $2 billion.
Okay.
We don't project that kind of revenue.
No,
when
I
we're
understand,
doing-
but okay.
but we are we're more conservative, and we projected about 500 million each on the royalties and the portfolio, so $1 billion. So we could be over that. Of course, the royalties, they're subject to commodity pricing,
Right.
and we have no control over the distributions that are received in the portfolios. That's strictly up to the managers and whether or not they have an active disposition campaign, whether the markets are generating dispositions or whether they're not, how active they are on the investment side. So it's different every year. All we can do is project, and we try to be as conservative as possible when we do that.
Any other questions from the board?
Those numbers look really good.
Thank you.
They
Listen, I think, I'll get on my soapbox for just a minute. I think the IEC has done a tremendous job in vetting the investments that we have looked at. We work with some really good managers, and my staff too does a fantastic job. So it's a group effort. We appreciate the commendations there.
One more question. On the energy side, are you finding in dealing with the private equity companies that their business plan is changing? I mean, I keep hearing that, the 3-year, 5-year flip has changed significantly. Are you hearing that they're going to a longer term?
You're talking about an investment period or
investment
a holding period?
The whole investment period. Well, the whole period. I mean, as far as the fund, the tenure of that fund.
All of these types of investments are subject to what's going on in the markets, what kind of opportunities are available. particularly in the energy business, it changes pretty quickly. There was, particularly after the energy bust, there was a pretty strong focus on minerals, acquisition of minerals, because the pricing was just so far below market. So we saw quite a bit of capital moving into that space. Obviously, I think the thing that I've seen that's more pronounced is you definitely see companies with a more distinct focus on a particular area, whereas before they may be sort of agnostic about which basins they were in. I think at this point they're very, very particular about the basins that they're in, particularly takeaway issues, because technology continues to advance, production continues to become more efficient and produce more products, so takeaway is more and more important. So it changes the whole complexion. The investment period itself, I would say it's becoming more compressed than the other way. But again, that's driven by the opportunity set. So when the opportunity set is robust, the investment periods are going to be shorter, and consequently it'll be the other way. There's a lot of capital that needs to be invested in the energy space. As you know, during the bust, a lot of people cut back their CapEx expenditures. And so the need for that capital now is even more pronounced than it would have been. So to me, that all means more of a compressed investment period. And I think just looking back over the past 3 years or so, the managers in that space have come back to market, I think, a little sooner than they have in the past because of that.
Thank you.
On a different topic, not to hold you to it at all, but right now, are you thinking do you kind of have a rule of thumb on a minimum size investment that the fund can deal with? I mean, obviously, we can't handle $1 million investments, but what is your rule of thumb right now on kind of a minimum size that we can really handle?
So given the amount of revenue that has been coming in and our projections for what's going forward, we think the size that makes the most sense for us now is a fund investment of about $250 million, and a co-investment size of 125, so roughly half of that. That's not always possible, but that's what we strive for. Happy to answer.
No further
any more
questions? Yeah.
No further questions.
As a reminder, this is a non-action item, non-voting item. Thank you, Rusty, for the brief.
Thank you.
And for the performance, as always.
Thank you.
And there being no further business before the board, we can hereby adjourn.